Is the stock market scaring you yet? The stock market started looking pretty shaky on Friday after a nice run-up so far. So what does this mean? Should you sell everything? In my last video, I discussed how the stock market looked too good to be true, and then early in the trading on Friday, it really didn't look good. Link in the pinned comments below. Before you go jump off a cliff, let's take a look at the kind of risk profile the market is presenting right now. So first of all, before we jump into this past week, let's go to the week before that ended February 3rd. And you can see how in the last 2 days of trading, the market's kind of pulled back here, but this looked still very healthy with the riskiest stocks up the most and the lowest risk stocks up the least. This is healthy looking. Well, what does that picture look like this week? Well, you can see that things continued to kind of go sideways here after the downdraft last week, the week before. And then finally, in the last 2 days of trading, everything started dropping. So this is an unhealthy look. You've got the safest Dow stocks doing the best and the riskiest stocks doing the worst. This looks very unhealthy, but is it really? Let's take a look. So if we look back over the past month, things still look pretty healthy, although you can see the riskiest stocks, ARK, have started pulling back. In fact, everything has started pulling back, pretty much except for the Dow. So we've got ARK up the most, NASDAQ up second, small caps up third, SPY, S&P 500 up fourth, and the safe stocks, the Dow, up the least. This is what you want to see in a healthy market, but I guess what everybody's concerned about is this trending downward here over the last several weeks. And if we look back over the past 6 months, how do things look? Well, again, this presents as an unhealthy stock market with the Dow doing the best, followed by the S&P and small caps, followed by the NASDAQ, and followed by ARK. But you can see since the bottom, if we look at the slopes of these, here's the slope for ARK. Oh, I guess I didn't match that color very well. Oh, let's put it right to the end point here. Followed by the NASDAQ. The slope isn't quite as steep. I'm going to skip small caps because they're kind of make it noisy here, but let's look at the S&P 500. And then finally, let's look at the Dow. So you can see based on these slopes, these current slopes, this looks very healthy. The riskiest ARK stocks are going up the quickest, followed by the NASDAQ, followed by the S&P, followed by the Dow. And if we look at the current bottom dynamics, these are designed to help identify when a bottom is happening and when we've seen the bottom. But we don't have a bottom happening right now. This is not telling us that. In fact, the bottom confirmation signal is heading up to a high point here with a high confidence level. This is nothing like a bottom, so I'm not worried yet. And what about risk versus opportunity? Now, I started showing this graph recently, but this past week, I developed another indicator that I think gives very, very timely information. And it's this sort of yellow-orange line here, which is identified by risk acceleration. So the red line is the risk in the markets, and the yellow line is the acceleration or deceleration of risk. So you can see how risk was accelerating here, and then all of a sudden, right here near the bottom, the risk acceleration dropped off way down here to 50. And even though it spiked here a little bit, you can see it's been stubbornly below 60 for sure, and near 50, and now it has dropped way off. And in fact, over this past week, the risk acceleration has been declining. This looks really good. This does not look like a market that's going to tank anytime soon. Now, this could turn around, but let's see how this plays out over the next week. I like what I see here. And what about equity versus safety? Well, you can see that the NASDAQ is still ranked number 1. This is what you want to see. Small caps have fallen down here to 4. What gives me concern here is that cash is creeping up into the top 3. That's not a good look. And we have an unhealthy Treasury market. So the longest duration Treasuries, EDV, are ranked dead last, followed by TLT, which are the next longest duration. This is not a good look for Treasuries. So Treasuries are not in a good place right now. And I'll talk about that when I show you the inverted yield curve and what has to happen for it to not invert anymore. What about buying and selling pressure? Well, no surprise here. You can see that the selling pressure is above the buying pressure, and you can see that things have been kind of going sideways. So kind of floundering is the way I would describe it. And what about the S&P 500 buying and selling pressure? Similar picture, although we had stronger buying pressure here, and now they recently crossed over, and the S&P has pulled back a little bit recently. Not a bad picture though yet. And what about the NASDAQ 100? Well, if we take a look here, very similar to the S&P, but much stronger overall buying pressure, but the selling pressure has moved up here as the NASDAQ has begun to pull back a little bit. And what about Russell 2000 small caps? Again, very similar picture. Buying pressure above the selling pressure until just recently. And again, the price decline here at the end. What about Ark Innovation, which holds the riskiest stocks? Well, you can see here we had very strong buying pressure all along here since beginning of January. And then recently it's tapered off and the selling pressure is shooting up as the prices declined. But remember, buying and selling pressure doesn't tell the whole picture. I really like what I'm seeing in the risk metrics that I showed earlier. But if this selling pressure continues to increase and prices continue to drop, those risk metrics will increase. On the other hand, if the buying pressure turns around and heads higher, those risk metrics should stay low, at low risk. So we'll have to wait and see what happens though. Now I've changed the way I show these sector rankings to make it a little more visual and so that I don't have to break it up into two slides. I know there's a lot going on here, so I'm probably going to have to show this on the entire screen. You won't miss my face though. So what we're looking at here is we're looking at the sector rankings. And remember from my previous videos, these move fairly slowly because they're looking over a longer time period. But what we have here is a pretty healthy looking market. What I've done here is see the risk level at the top. So red means these are riskier sectors. Green is obviously cash, which is risk-free except for inflation. And then yellow is a little more risky. So red are the riskiest sectors, and yellow and green are the safer sectors, except for gold, which who knows what that is. That's not correlated to anything. But what you want to see here in a healthy market is exactly what we're seeing. We have the riskier sectors up here: technology, emerging companies, emerging markets, technology. These are all up here where you want them to be in a healthy stock market. And you want treasuries and cash down here near the bottom. This is a healthy look. Now, you'd like to see consumer discretionary above consumer staples. It's not there yet, but let's take a look at the next slide. So now let's look at how these sectors are accelerating. So let's look at how their accelerations are ranked. And if we look here, again, a very healthy stock market. Technology up at the top, emerging companies. We've got the Qs, NASDAQ 100, above SPY and the Dow. We've got consumer discretionary accelerating up. It's above consumer staples. This is what you want to see. And again, treasuries and cash are all down here. So this is a very healthy looking stock market so far. And speaking of treasuries, let's look at those. So if we go back 1 week to February 3rd, you can see that treasuries tried to rally here and then failed, but ended the week in a healthy distribution here with the highest risk treasuries ranked 1 and 2 here, up the most. But what happened as of this last Friday? Well, you can see they failed. They tried to rally again and then failed even more. This does not look good, and I think it has something to do with the inverted yield curve. So why would that matter? Well, if we look at the inverted yield curve, what has to happen for this to be not inverted? Well, either short duration treasuries, like the 2 years and T-bills, those rates would have to come down, meaning the Fed would have to lower rates because they control those rates, or rates on the longer term bonds, like the 10-year and 20-year, would have to go up. Well, if those rates are going to go up, then those bonds are going to fall. And that's in fact what you see happening right now. And if they fall enough, if the bond values fall enough, that means the yields go up, and that means the yield curve will no longer be inverted. I'm not saying that's what's going to happen, but that's one of the ways out of this. And right now, that's what's happening. So what kind of story are we being told by the buying and selling pressure for treasuries? Well, you can see that the 3 to 7 year intermediate treasuries had a nice run up here, kind of went sideways, and now they're going down. And you can see that in the buying and selling pressure. Buying pressure dropped, selling pressure going up. 7 to 10 year, what I call intermediate to long treasuries. Again, price went up, sideways, started dropping, and selling pressure now above the buying pressure. And what if we look at long bonds, 20 years? Again, price moving up, sideways, and down. And the selling pressure is really shooting up here. So we'll have to see how this plays out. And what about gold? Well, gold had a nice rally here, kind of went sideways, much like the treasuries, and now has been tapering off, and the selling pressure is above the buying pressure. And finally, what about Bitcoin? These are probably the riskiest assets that I'm evaluating here. Again, very nice rally, flat topped, dropping prices. You can see the buying pressure was just magnificent here, way above the selling pressure. Tried again here to go up, but now the selling pressure has moved above the buying pressure. So if you look at the 1 month trend, it's heading downward here. That's not necessarily a good look. As I keep saying, my advice is to stay put until the metrics that I presented earlier degrade much more than they're degrading right now. We're not in a bad place yet. Most of the time, the best course of action for all investors is inaction. Don't do anything. Take the long view, keep dollar cost averaging in, and you'll be fine over the long term. Right now, the equity and risk markets are looking reasonably healthy. Enjoy the ride while it lasts. I'm Calvin Rose, and thank you for watching Invest Smarter today. That's all for now.